Hello and welcome to Newslaundry Interviews. Today in our series where we interview authors, we are interviewing the author of Rise of the Phoenix, the Apollo Tyres story by Udayan Dravid, who is here with us. Thank you so much for joining us.
Thank you, Abhinandan.
Mr. Dravid, I have full disclosure, Mr. Dravid also is my cousin. So I'm not used to calling him Mr. Dravid, but for the purpose of the interview, that's what we will do. Udayan is an alumni from BITS Pilani, and you were the chief marketing officer of Apollo Tyres, and now he runs a consultancy called
Connect Hub.
Connect Hub, and a healthcare
Company.
Logistics you manage, but we'll get to that later. But this book is about the turnaround of a brand which was ailing or kind of stagnant. And I've read the book. I'll ask you specific questions on that later. But first I want to ask you, now you work, I know you've worked as a consultant on digital projects, on healthcare, of course, you work on logistics. But you were part of, an important part of the turnaround of a bricks and mortar manufacturing company. And of course, in the book, it's clear the importance of relationships with your sales people and distributors is a very important aspect of your turnaround. Why is manufacturing so important even today in where every big company is on data and digital?
So you got to understand that in the journey of an economic achievement, you have what you call as a primary economy, which is largely agriculture based. Agriculture, mining is a very primary economy. And then comes the secondaries, which is manufacturing, and the tertiary economies, which is services. But no sector can absorb the kind of labor force and improve the quality of life other than manufacturing.
Okay.
So the services industry is, while it has the highest value creation, and undoubtedly most evolved economies want to move towards the service economies. India probably is the only case which actually missed the manufacturing bus. We missed it to China. And we straight away become a very large service revenue economy. But for the kind of workforce that we have and the size of workforce we have, I think manufacturing is very critical because it also does two things. Not only does it create producers, it also creates consumers. Because the goods we produce here can actually get consumed in India. And it is very critical that India manufactures at a very large scale. And you will, because the problem with the service economy is the movement of value can move very fast across continents. So if you have a data center in India, tomorrow, or a call center in India, tomorrow English skills are available in Vietnam, they just have to move out. You can't do that with manufacturing so easily. And when I talk manufacturing, I'm not talking the nuts and bolts, screwdriver kind of assembly line manufacturing. I'm talking of hardcore manufacturing. You can't uproot a steel plant. You can't uproot a tire manufacturing facility. You can't easily uproot a automobile manufacturing plant. These are things which are needed and they need large investments. And therefore, it's important to look at manufacturing in a very different manner. And that's why in this book, there is a whole chapter on the role of financial institutions. Because without an ecosystem of capital availability, manufacturing cannot revive.
But that, I mean, is a more recent phenomenon. Now there is some, space where there is some availability of capital. When you were part of this industry, right in there, capital wasn't so easily available.
Capital, in fact, for manufacturing was more easily available than it is
that
available
right?
now. Yeah, because you had the development financial institutions which took a very long-term view of investment. See, most manufacturing is asset-based. And assets in an inflationary economy become cheaper over a period of time. So if the first tire factory which was set up cost around 32 crores of rupees way back in 77. The same size of plant today will cost you around 400 crores. So in an asset business, even if you're incurring losses, you keep putting in capital. At some stage, it will start generating returns as long as you're efficient. At that time, the financial, in fact, the IDBI's role is so critical. They supported the company in spite of the
we
fact
had a chapter on that in the economics book back in the day.
6 crores of equity, 32 crores of losses, and they continue to support. They would give money for, banks would give money for paying off salaries.
But did not that, would you say it was that culture that led to the kind of huge defaults that we had of industrialists taking huge loans, not repaying them? Every year there is this list of non-performing assets, which seem almost malicious in how that capital was raised. Did it have a downside as well?
See, every economic model has downsides. You look at equity markets, it's not that people don't lose money in equity. Somebody loses money even in equity.
Yeah, but that is chance. I'm talking about when, capital, especially with private banks. I mean, you see the case of Yes Bank, where, the ED is actually investigating. There's so many other banks. IDBI, I understand, it was different. The incentives were different. The reason it was set up was different. But the ease of capital to large industrialists, has it, you think, in, let's say, post-liberalization or even in the 21st century, has it had more downside, or has that capital actually served the country in building the assets that you think are important?
So you got to understand the financial structures of that time. There was IDBI, IFCI, ICICI. These were three large development financial institutions. And there were also the state financial institutions. You had Haryana Industrial Development Corporation, you had Rajasthan Industrial Corporations. The state industrial corporations funded the MSME sectors. So the Faridabads and the Sonipats and the Ghaziabads and the Noidas, they were not created by IDBI. They were all created by these small people who were taking smaller loans, setting up smaller factories. And the backbone of these state financial institutions came from the IDBIs and the ICICIs. They were partners in all of this. So when they went down, everything went down. So today you see Faridabad, Ghaziabad, they are industrial deserts. 30 years ago, they were teeming with factories. And there were thousands and thousands of people employed over there in manufacturing. But they're graveyards today. So the fact of the matter is that you got to understand the mindset of a development financial institution, the mindset of a bank. A bank fundamentally has a more short-term horizon to understand the usage of capital. And I'll tell you why it is so. You want to go and buy a car, you'll get it at an interest rate of 8.5%, 9%. You want to set up a factory, you won't get it at 9%. And if you want to set up a factory, you will not only pay the higher interest, you will also give a personal guarantee, you will also give a collateral guarantee. You don't give a collateral guarantee when you buy the car.
Sure.
The only reason why you get a lower rate of interest is because the car can be repossessed. Right? And their horizon is 5 years. They're making money in 5 years. In a factory, it could take 10 years, 20 years. A lot of large businesses in the initial phases never made money.
So it's basically how long your time horizon is. Okay, that's the macro picture. We'll get back to that later. Let's get back to your book of the Apollo Tyres story. So we'll get to the bit of, how you created this sales network, incentivizing and keeping them high morale, the relationships that were built, etc. But for a brand like this, like I remember Sachin's MRF bat, sometimes when we see the amount brands spend on just visibility, why is it so important? I mean, how does it actually significantly impact how that company is performing?
So there is a direct correlation between stock market valuations and advertising and brand recall. So you would notice that every time there is an IPO, companies start advertising their brand. It makes sense because you want people to, they think, oh, this is visible, this will sell, and therefore we can put money behind the company. But it also depends on the nature of business. So if you're a consumer-facing brand, for example, if you were selling a cosmetic, you need, because these are impulse purchase products. You go to a hypermarket, you see a brand there, you say, oh, I saw that on TV, I'll pick it up. Low value, impulse purchase, repetitive purchases need huge investments in branding. Products which are more long-term, the purchase is more considered purchase. There is more research behind the purchase. you need more elements to decide on consumer behavior, and advertising will have a limited role there.
So a car tire will fall in that category, right?
A
Because
car
it is-
tire or a scooter tire will fall in the category of high level of advertising.
Oh, as an impulse purchase, but these are
Yeah,
expensive
because what
things.
happens is that you're picking up a scooter tire which is costing you 400, 500 rupees or maybe 1,000 rupees at best. But when you're buying a truck tire, it's costing you 20,000 rupees. The whole equation is different.
But the brand that is making both is the same.
Yes, but there's probably very few companies which straddle both ends. It's like if you're buying a very expensive car, you would have a very different consideration for purchase than if you're buying a scooter.
I see. So today's management professionals who are entering the workforce, what can they learn from your experience of, creating a brand that then outperformed others from a fairly stagnant position? Is the story of what you did back then relevant to today's professionals? Or has the market changed so much, technology and media changed so much that the rules have completely changed?
So there is the essence of business is what I talk about in this book. We always talked about the four wheels of business. So the four wheels of any business is consumers, shareholders, employees, and suppliers. The four wheels have to be equally inflated. Otherwise, what happens is the vehicle will stall or it won't move as fast. Most companies commit this mistake. Either they are too focused on shareholders, so they compromise the suppliers, they squeeze the suppliers, or they would be completely focused on consumers and not bothered about shareholder value. At the end of the day, everyone has to succeed in the game. A shareholder needs to make a reasonable return. A consumer needs to get a good contemporary product. An employee needs to be satisfied, to be motivated to do the right thing. And a supplier needs to make adequate return to be continuously being able to upgrade technology to keep pace with the product innovations with the user wants. You keep squeezing suppliers, at some stage the supplier will stop investing. You keep squeezing customers, don't upgrade your product, they will stop buying. You keep squeezing shareholders, taking them for granted, your lenders or your financial supporters, they will no longer give you more money. And you keep taking your employees for granted, at some stage they'll leave you. They won't do the right thing.
So what did you find when you were given charge of this turnaround, and what did you do to change it?
So actually, there's something which I always hear is this is bookish. You will hear that with most managers. He's talking theory. But theory is actually years and years of practice. And experience is actually a limited amount of time multiplied that many number of times. If what you're doing in newslaundry, you probably did it in the first 2 years. Now it's a little bit of repetition, a little bit of additions here and there. So it's important for people to be able to absorb younger thought. And I always believe that in world history, no old man has built an empire. Alexander was 32, he conquered the world and died. Jesus was 32, established the greatest religion. Shankaracharya was 30, 32. Akbar became emperor at the age of 13. Because the young people dream and the old people look at the past. What Apollo did was, the first thing we did was we relied on younger people. We brought in younger people to work with us. And we brought people from other industries. So in fact, one of the criteria which we put there was we did not hire anybody from the tire industry above a certain level.
And that helps how?
Because let's say if I'm in Apollo and I'm hiring somebody from another tire company, that guy will keep talking about what they did in that company. But we are not creating that company. We are creating a completely different company. If newslaundry hired from another media company, they will talk of what the other media company does because that's their experience. But newslaundry is not that media company. Newslaundry is creating its own identity and its own thought. So these younger people are the people who were given only one task. They had to create one actionable idea every year, which could be executed well.
And that idea would be in...
Could be anything. Packaging, it could be in pricing, it could be in distribution or anything. So if you have 300 employees, each one generating one idea, you cannot execute the number of ideas. You have 300 ideas in a year. No company can absorb that many number of ideas. So here was this company throwing up different ideas. So you'll see that in that book, every single thing we did, we would not do if another tire company was doing it. So if they did something, we would not do it. We will do only something which nobody else is doing. And that built a differentiator. So here was a company which had no money, no brand, no differentiator as such, but it became different. And people buy into differentiation. So you see a movie and you see a group dance. You'll saw all the extras in one color of clothes, but the hero and the heroine will be in another color of clothes. Because that's when everyone focuses on them. And it became a differentiated product. And because it became a differentiated company, it became a differentiated product. People saw that happening on the ground.
That how difficult is it to change that kind of culture, inertia or established ways in working for any company, especially when it's large and is legacy? I mean, it's not like you're creating a startup. Startup, you create the culture, you create everything new. But something that's already existed, changing is always more difficult than creating, right?
Yeah, it was not easy, and it wasn't short term. It took years. It took a lot of years. It took a lot of commitment from. So what you see in the rise of the Phoenix when we went for the unilateral price increase, that whole process took something like 4 to 5 years till we reached that stage where we could challenge and take a individual position. It didn't happen overnight.
That means you have to have that kind of consistency, which means in today's day and age where thinking is quarter to quarter, is it more difficult to think long term for any company? I mean, I've heard this criticism and this frustration from many of the professionals I deal with today or I meet, whether it's socially or at different events, that even though you know the right thing to do from the long term perspective is X, but the consideration will always be quarter to quarter.
So the stock market only looks at profits. I don't think Apollo ever lost out on the profit game. It always delivered better returns, in spite of the fact that it was doing things differently. So I don't think there is a conflict there. If you try to do the same thing the same way, it's like a paradigm, and I'll explain the paradigm. A normal human being can walk at the rate of 4 kilometers an hour. If you were to do a slow jog, you do 8 kilometers an hour. If I told you you have to do 8 kilometers an hour consistently for the next 6 hours, unless you're a marathon runner, you can't do it. But if you had a bicycle, you could move 8 kilometers an hour. And if you pedal very hard, you'll do it at 20-25 kilometers an hour. But I tell you to do 25 to 30 kilometers an hour consistently for the next 8 hours, you can't do it. But if I give you a two-wheeler, you can do it. And then you can do 90 kilometers an hour for 8 hours if I give you a four-wheeler. This is a paradigm shift. The difference is that you are not walking. You're defining your business as locomotion or movement. And once you define your business correctly, you will be able to do better. And classical case is the watch industry. The watch is a timepiece, but Titan defined it as a fashion accessory. The moment it defined it as a fashion accessory, you didn't need one. You needed 6. HMT used to sell one watch which was given at the time of your wedding. Probably by your father-in-law.
And now it's jewelry. Now people position it as jewelry.
Because the watch is the role of the watch and the timepiece is being done by the mobile phone. So when we started selling tires, and we were largely in the truck tire business, we said we are not selling tires, we are selling consumer vehicle finance. The moment you say we are selling consumer vehicle finance, you change the rules of the game completely because everyone else was selling tires.
Explain that to our audience.
So in the truck tire business, the tire is always sold on a credit. So the dealer takes the old tire. Let's say the tire price is 10,000 rupees. The old tire will fetch you 3,000 rupees. So he takes the old tire. He gives you a new tire. And you have to pay him over a period of 6 months. Har baar wo chakkar laga ke aata hai. Takes a trip and gives you some money because he's short on capital.
It's on installments.
So he's basically financing the trucker. Right? Now, the moment you define this business as financing the trucker, interest rates plays a very important role in the business economics. The nature of dealers are not people who understand tires. They are people who understand vehicle finance. That's how we started getting financing companies into the business, Artiyas into the business.
You change the kind of The
people-
profile of the
people
the-
who came in, and they were completely new people, and more capital was chasing us. So there is this chapter on recurring advance scheme. So there was a time when we were running short on capital, and we increased the interest rate to, I think, 36 or 48%. Everyone thought we were going bankrupt. We weren't going bankrupt because we were taking 48% from you on interest, and I'd increased my prices. So on the price side, I was getting a better arbitrage. You were giving me money. Now that you've given me money, you will buy from me. So I had no worry of collections and bad debts.
So you already had certain
Pre-sold,
amount
right?
on your balance sheet. You had,
and in that model, what was done is that for the finance team, what was the difference was treated as a discount. So if they were borrowing, let's say 12%, and I was taking a deposit at 30%, 18% was put as discount in my kitty. It was sales discount. So they were okay. I was being monitored on the discount that I was giving. And because I was able to sell more, rotate my inventory better, I was actually selling more and therefore making more money than anyone else. And at one stage, what started happening was that people used to buy from other companies, sell it off in the Delhi market, raise money, give it to us. So the other tire companies started financing us. So I think one has to understand where you're making money. We were making money on selling tires. Other people thought that we were making money or losing money because we were taking deposits. Now, it would have gone completely south if we had borrowed that money and not been able to sell tires. Then it would have been a disaster.
so both have to be in tandem. You have to have that kind of sales happening so that you can offset this advances that you're taking. Okay. Now, coming to the competition in a market which is, you see famous Tendulkar bat, you see lots of ads. As a marketing officer or, CXO, potential people who are watching, how much of your involvement or anyone's involvement is there in how the brand is positioned out in the market? Because ad agencies are pretty much dead now. Now everyone goes by influencers. The entire way where you went to market with any product has completely changed. What was involvement then? What do you imagine is the involvement of that marketing officer today?
See, one of the misnomers of marketing is most marketing officers, I'm sorry to say that, think that marketing communication is marketing. It's not. It's a very small subset of marketing. Marketing really starts from understanding the consumer. And the involvement of marketing people in product design makes a huge difference to success. For example, the reason why Apollo went down was it was manufacturing led. At that time, there were premium on the tires. So they just got designs from US and whatever, and they started putting tires in the market, and they failed till the people started getting actually involved in designing the product. So there is a chapter on how we reconfigured the product, Hercules, Lodestar and Milestar XT7. We realized that there is a consumer segment which is overload. They just want that. Just imagine a 20-ton truck on 2 axles, a single axle overload truck, which used to happen in those days, and the tire falling flat. The guy can't even put it on the jack. He doesn't want the tire to fail, right? So he was willing to pay a premium for it. That consumer insight is very important. If you have that consumer insight, you will do the right pricing, you'll do the right positioning. Communication is only about conveying what the product is offering. What Sachin brings to the brand is the trust that Sachin brings as a cricketer. That you put Sachin in the field and you will hopefully win the match. And more likely than not, he will deliver, whether others deliver or not. The trust factor is what he brings to the brand. The brand in itself is more than just the trust. The product performance, the product relevance, each one of those things are important for a consumer. And if you don't do that entire gamut of activities, it won't work. You have brands backed by celebrities which have failed. It doesn't work.
Finally, I want to get to the big picture, your experiences since then in logistics planning, in the healthcare industry, in Connect Hub, consulting for other companies. What is the significant difference between the landscape of industrialists or the companies that are seen as the top performing companies or the most relevant companies in India then and today, what has fundamentally changed in your view?
What I might say will sound blasphemous. Is that the valuation game, which all businesses today look at, is in my view the Achilles heel for industrial growth. A business has to be fundamentally efficient, fundamentally profitable, fundamentally relevant. Then when you get a valuation, makes great sense. It will always succeed. But if I can't ever imagine that a business has losing 3,000 crores, has a revenue of 10 crores or 20 crores or 100 crores, and you create a valuation of $1 billion. That's why some of these big companies have gone under.
Byju's being the most notable of them.
If you look, in those days, the top executives of the company always visited their manufacturing locations. They visited their consumers. They visited their dealers. They visited their stockists. I don't think many people do that today. They're happy looking at a spreadsheet and looking at valuations.
And what does that actually achieve?
Because they don't get a first-hand feel. A classical case of how a brand can be built because you go and listen to a customer insight is that famous campaign of Coke, Thanda matlab Coca-Cola. You know, when you go to Haryana, if you have traveled on the Haryana Roadways bus, people don't go and ask for Coke or Pepsi. They say Thanda dena. And the Thanda is put in an ice box at the bottom with ice lying on top of it. That insight is what created Thanda matlab Coca-Cola. So that consumer insight will only come if you go and sit there. There were days when, I used to have a dealer from Rewari who used to come to me every day and say, "Mere ko tire de do." I said, "Yaar, Rewari mein, why do you need so many tires?" He says, "Aap aake dekho." I actually went and sat at his counter from 9 o'clock in the morning till 7 o'clock in the evening, just sitting there having endless cups of tea. And I saw how he was selling tires. How many consumers came to him? Wo kya bechta tha? And the next day I came and increased his allocations. Because he was actually what he was doing. He was buying from Delhi and selling in Rewari. Because nobody went to Rewari. They thought, ye to pata nahi kya karega tyron ka. Idhar udhar karega, paise duba dega. It didn't happen.
So you think visiting that last mile, the last person who's actually dealing with your consumer can really change how things work at the top?
Yeah.
And that has fundamentally changed, you think, in today's
In
startup culture.
In Apollo, those days, the entire top leadership used to be sitting in a meeting with dealers, where dealers would stand at a podium and say, "Your tire is useless. We sell the tire. This problem is that problem, that problem." People would be taking notes, going back, fixing the tire and coming back. Ravi Maman, he's unfortunately no more, used to come to Roshnara Road, sit at dealer's shop as the managing director of the company. Fixing his, understanding consumers, what are they telling him? Went back and fixed the product. MRF became a great company.
And why do you think that's not happening today?
Because today there's an interesting arbitrage. If you run a business where there's a dollar arbitrage, you're paid at $8 a day vis-a-vis $8 an hour in the US. There's no reason for you to be more efficient, no? Just the currency gap gives you the profit.
Right. So you think...
And that is why manufacturing people, in my view, and a lot of people may not like me saying it, have a better understanding of cost. In a cement business, just, you go to a cement distributor in the evening, you will see him collecting that cement. When you throw the bori, the bag, there's some cement which comes out. They collect it and they sell it. You go to a jeweler's shop, there'll be beggars sitting outside who will be collecting that mud and taking out
Dust.
the filings or whatever. The contract for the jewelry exchange, complex in Bombay is given for a couple of crores of rupees because they take out that metal out of sewage. So cost consciousness in a manufacturing business is far greater. Because that little thing can make a huge difference. Now, that doesn't mean to say it doesn't work in service industry. So airline industry in the US is a classical case. They took out one olive and they saved millions. So cost is something which Either people focus on cost at a time when they're going under, when there's nothing left, or they focus on cost because if you don't focus on cost, you won't survive anyway. But wherever there is a pure valuation exercise where you're chasing a vision, which people call as vision, somebody would call it a dream, there is no logic to it. There is no economic logic to what you're doing.
So let me get back to the beginning, something you said in the beginning of we missed that bus to China, and you are still involved in brick and mortar businesses, whether it's healthcare, and you consult for others as well. Why did we miss that bus? What is it? Is the red tape of making anything happen here too great, so people are just fatigued, they will not get into it? What was the cause when we had a population, we had a good start?
So I think it's a collective collapse across the spectrum. So there is clearly, if you see the 90s, the 80s and the 90s is when the development financial institutions kind of disappeared and they reinvented themselves in the form of banks. Two of them did, ICICI and IDBI. That resulted also in the collapse of the state financial institutions. So financing became a very different game. That was also the period of globalization. And because of our large English-speaking population and a very large engineering base, not in terms of, let me correct me, very large English-speaking population, there was a huge market which was coming out for KPOs and BPOs, which is where the labor force really went. And because they were white collars, simultaneously you could see a collapse in the skill centers. So there was a layered skill structure to support manufacturing. There were the ITIs, there were the polytechnics, and there were the engineering colleges. So the ITIs are no more. And the polytechnics are no more. You don't see them, right? And that is probably the reason why the government had to come back with Skill India and all those programs, because those are, all that they needed was to revive these institutions. And they were producing fitters, welders, electricians. The ITIs were doing precisely that. And when you look at engineering, the most preferred engineering disciplines became IT, computer sciences. They were no longer the hardcore manufacturing, civil.
Although now apparently there's a comeback on robotics, because now with AI, robotics being an important part, apparently there's a comeback of computer engineering and mechanical, which was the least desired in the middle.
So the quality of talent which was available was going down. The market was moving towards the service industry. And because those are more glamorous, see, blue-collared environments are tough. Factory environment is tough. It's hard. Air-conditioned BPO environment is good. It's glamorous. Right? So the younger force also wanted to, it was a good thing going for India. There's nothing wrong with it. I'm not saying that.
But it wasn't sustainable.
How can it be? Because the day you increase prices, someone else is coming up now. So Philippines is catching up. Vietnam is catching up. They will all catch up. I still remember, and also, even today we have this thing about where 100% FDI should come in and where investment should not be allowed to come in. One of my father's friends, he was a communist. And he once told me, he says, what's the problem? We should allow them to come and invest 100%. Factory उखाड़ के थोड़ी ले जाएंगे. सड़क उखाड़ के थोड़ी ले जाएंगे. लगाने दो पैसा. एक बार बन जाएगा, फिर देखेंगे. Sectors, you can really get all the foreign guys to come in and do whatever they like. And there are sectors where you should not allow them to come in. So I think a lot of things, the wheels had to come together, which China did beautifully. If you see what China did, they allowed everyone to come in. हर एक ने factory लगा दी.
Right. Now, as a case study, which you studied after engineering, you did management as well. When you study management, one of the things that you said about the polytechnics and the many, I can tell you from the people who I have encountered in the last couple of decades, many of them are unemployable. I think that India churns out the highest number of unemployable people with degrees. they may have a degree, but they just don't have the basic discipline of working. I mean, I may be sounding like an uncle, but I've heard many other people express this exasperation. A simple example, if you go overseas, it's not a very educated person who's handling the counter of, let's say, a breakfast deli. He or she is taking the order, he or she is cooking, he or she is taking the money, he or she is serving you. One person, and I've seen this, and often I think, would I entrust 3 tables, small counter, gas stove, and one person doing it? Here, even if you go to the smallest dhaba, there are 5 people. There's one guy sitting, taking the money, one little violating all norms, serving you, someone cooking, 4th guy cleaning. It's just and I'm saying at a very basic level, even at a more so-called educated level. What is the reason that, and did you find this frustration back in the 80s and 90s, that too many people who have the degree, who have been to the college or whatever institution, but in a work environment, incompetence is significant?
See, you have to understand one thing. It's wrong on our part to expect the education system to provide everything to people. There's no debate about the fact that the education system has not kept pace with the requirement of the industry. No debate. But it's also a fact that when we started our careers, our managers were mentors. I've been taught by my bosses. I've been fired by my bosses, no doubt. They were rough. They were the kind of bosses I worked. I was privileged to work with some of the best brains in Indian industry. And they taught you. And companies were learning grounds. DCM, it used to be, the management trainee scheme of DCM used to be better than IIM Ahmedabad. If you became a management trainee in DCM, it was a feather in the cap. And the interview process itself was so rigorous, with Dr. Bharatram sitting on the panel with the entire board, interviewing and then deciding there would be an entrance test and so on. And once those people came in, they were groomed. 1 year, 2 years, they were put in departments, they were mentored by people, they were watched, they were taught, and they became giants. At one stage, the entire top leadership of manufacturing in Delhi at least came from DCM. So today's managers, and which I can say out of experience, do not want to teach. They just want, मेरे को एक trained बंदा दे दो. You give me a person who knows. And because of that, what happens? Your cost structure goes up.
Because you'll pay more for that.
You'll pay more. What we did with Apollo was exactly the reverse. We worked with raw material. We groomed them in our own culture. And therefore cost was lower. They were all younger. They were all willing to learn. And because they were younger, see, young people need mentoring. You can have the biggest badmash in a class actually being the best kid. That's the way youth is. Because youth by its very nature is inquiring. Youth is by very nature is questioning.
Is it still? I mean,
intrinsically,
people have to want to learn as well, right? Because, I mean, let's talk about your generation. They were tough. People, when you didn't perform, they were tough. They were not always mollycoddling you while teaching you. You think today's youth are also willing to learn?
I think, and I don't buy that argument that all rich kids don't want to work hard and all poor kids want to work hard. No, I have had in my experience people from very good families working their butt off. Not because they needed that money, but because they really were passionate about what they were doing. People from small towns wanting to, and girls particularly, wanting to come from the Lucknows and the Kanpurs. And when you ask them in an interview, why do you want to come to, he says, we want to be independent. They want to move away. They want to work on their own, struggle on it. It's tough. But I think we have let these kids down. We have not done enough to give them the environment for success. It's easy for us to say, aajkal ki generation bekar hai. That's not a completely true statement, because the today's generation has evolved out of the previous generation.
Right. And before we close, coming back to your experiences in the Apollo Tyres story, Rise of the Phoenix. Give me an example, a story, an anecdote that stays with you, which you think was a big teacher for you personally, that really left an imprint on and defined much of what you left behind when you moved on from Apollo.
An event in Apollo Tyres.
While you were working there, while you were, operating this entire management network, sales force, etc., etc. Something specific that happened that made you say, okay, that has taught me so much. Like the Rewari example you gave, or anything.
So there was a phase in the company where there was a family fight going on, capital was scarce, expansion has started, and every day something or the other used to come in the press. And you'll be surprised that was the time when we had the lowest attrition in the company. Every day in the morning I would come, my office used to give me the cuttings of the newspaper. I would take my team on call and tell them, this is what the paper is saying, this is what is our stance, this is what is the official position. Every single employee was speaking on behalf of the company. There was no spokesperson. Every employee became the spokesperson. And at one stage, because there was so much of cash flow pressure, I personally started losing it. And one day my secretary, Rajendra Prasad, he came to me. He says, "Sir, I want to tell you something." I said, "Yeah, tell me." He says, "Aap sun lijega." "Yeah, tell me." He says, "You started losing it very much. People are scared to come to you." That's when I realized that when the things are tough, the bosses need to be cool. So the easiest thing that can happen is that the leadership starts coming under pressure and the pressure starts going down. And that's why it's important. If the ship is in a storm, the captain should be cool. And you don't have to flounder. That taught me something.
And finally, if you were to today have some advice for News Laundry as a brand, the news environment is so cluttered. It is, and of course, most of your work has been in logistics and supply chains, etc., etc. That's your area of expertise. But you've advised people on other stuff as well. In a news environment that is as cluttered, as confused, where fake news is also a thing, what would be a differentiator in your long experience and area of expertise for a news brand to stand out and stand apart? What were a few suggestions or advice you'd give?
I think you need to understand that one shoe fit all is not the right strategy for any media company. Because you're talking to different audiences. So if you're looking at, let's say, there are people who are just not interested, let's say, in politics and current affairs. They're only interested in fashion. They can be part of even in fashion, there is something to be said through media. And that also is not very honest, by the way. Okay. And similarly, something to be done. So basically, your job is market share. As the CEO of the brand, your job is to expand the market, grow the market, create more revenue streams, and build a bigger portfolio. And I'll give you an example of how this has evolved. When the market evolves, segmentation becomes very important. In the 1960s, there was only one shampoo brand. It was Tata Shampoo. Only one shampoo. There was Sabun and there was shampoo. And then in the 80s, you had Sunsilk egg shampoo, anti-dandruff shampoo, this shampoo, that shampoo. Today, the market has evolved completely. And you have some 20 types of shampoos. Hair repair shampoo, oily shampoo, this shampoo, that. Because each of those segments is viable on a standalone basis because the usage of shampoos has grown up so much. At that time, not many people were using shampoos and therefore the business case was not relevant.
Also, huh?
Yeah, business case was not relevant.
Right.
Same thing is with media. The way to cut through the clutter is to create specialist properties. And if you build specialist properties, you can cut through the clutter that makes the business more viable. And then you decide, pick and choose, cherry pick.
Right. Thank you for your time. Rise of the Phoenix, the Apollo Tyres story. The link is in the show notes below, like there is for all our books and authors who we interview. I do hope you learn from it and management students. You also go teach management students?
Yeah, I do. Not in the recent past, but I do. I used to at one point of time.
And what was your takeaway from them? I mean, was there a change since you were a management student or not really?
So I studied in a university structure, which was more academic. I was part of the University Business School at Punjab University. The more contemporary management schools are not so academic, they are more case driven. They are more oriented to the job market.
So the pedagogy has changed.
Yeah, to that extent there is a change. But they respond well. If you can talk to those kids and are able to arouse their interest, they respond. They're keen.
All right. Thank you for your time and all the best for your book.
Thank you. Thank you.
Bye.